Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Today we're joined by Lucas Porbeau from Lonsec. He's an investment guru that works at Lonsec, looking after all things about the market, an economist. So we've got a few questions to run through with Lucas about what's happening in the world, the share markets, and investment portfolios across the board. So thanks for joining us today, Lucas.
Something I picked up on earlier, you talk about risk and opportunity markets, and of course you mentioned some geopolitical uncertainties, particularly in the case of Russia-Ukraine war. You got Putin out there making all sorts of threats about what he's going to do and going nuclear, and some things that obviously makes investment markets gyrate. I guess, because you did mention there's risk, but also opportunities, I wouldn't mind hearing your thoughts on what risks there are. I think you've spoken to that a little bit, but also what opportunities there are. Just in my mind, there's the one that came to mind recently was Woodside Energy, which is an Australian company. Recently signed a deal with a European company called Uniper Global Commodities to supply LNG to Europe. So I'm just wondering whether you can see any opportunities for any other industries or companies in this.
Yeah, I mean, I think so. Yeah, there's a bit there, but I think there's certainly going to be like tactical opportunities. So if you think about the conflict in the Ukraine and obviously the energy issues that Europe is having on the back of that, in terms of energy supply, there has been a sort of recalibration of, every country's had to, over there, has had to recalibrate or secure energy, which is still the case. So we have seen more broadly some of the, commodity plays, companies that have got that exposure do reasonably well because obviously demand has gone up, and supply. So, but I think in terms of opportunities, like I think if I was sort of to really sort of take a bigger step back and sort of at a high level, I think I do think some parts of the market have been oversold. So when you see, this whole sort of, if you look at the data over the last sort of 6 months or so, or 12 months, and you look at, the overall performance of the share market, and so what has done well and what hasn't done well. And it's been a really interesting dynamic in terms of it's been such a narrow market in terms of what's done well, and what's done well are resources and energy. Effectively, on a broader sector level, anything outside of that, you've probably lagged, right? So unless you sort of tilted your whole portfolio to that narrow part of the market, you've probably underperformed, right? But what that also tells you is that for that part of the market that's underperformed, it's just been wholesale selling. So I referenced the tech sector in the past, right? So there's no doubt about it. Over the last several years, you've had tech companies that have only existed because there's cheap debt, right? Now that's done. That's finished. But conversely, there's quality companies, your larger companies in the market, that if anything, they're probably going to get stronger, right? Because in these environments, you tend to see some of the bigger guys, gobble up some of the smaller ones, and if anything, strengthen their position. So I think there's areas. I think it's always interesting to look at those parts of the market that have been just holus bolus sold off, because within that there's going to be winners and losers. On an asset class level, probably the key one I'll sort of call out, which is probably not the most exciting part of the market, but if you think about bonds, government bonds generally, the consensus view over the last several years has been, well, why would you invest in bonds? Because you're getting no return, bond yields are zero or close to zero, why would you go there? Roll forward today, and bond yields, again, depending on the day, but you're sort of hovering in the high threes, early fours. That's a very different dynamic go forward. So certainly our view would be that bonds are, traditional bonds, government bonds, are far more attractive today. Yes, they've been volatile because we're transitioning from low inflation to high inflation. But if you roll forward and think about, okay, well, if you're going to get 4%, roughly, give or take, that's a different proposition from zero. And then, then you've got to see from a relative perspective, what are you going to get from equities and so forth. So I think this is sort of recalibrating things in, certain parts of the market, which, were easy to say, I'm not going to even look at it because it doesn't look attractive, and now sort of coming up. Even interestingly, looking at TD rates, and you guys will be sort of close to this, there's some institutions now you're getting a pretty decent rates at the moment. So it just means a whole recalibration of where the opportunities are. And it may be the case that, yes, some of those defensive assets are now starting to look a lot more attractive.